maybe we can get started. I want to thank DealFlow for having me back to the SPAC conference again this year.
Maybe they can turn the music off. It would be great.
It's okay, I was going to start singing. Just kidding. So I think this particular panel comes at a really important time because it's the last of the day, it's the last of the conference, and it's really going to reiterate with insights from my panelists who are truly experts in their respective fields. And I think it's going to really just seal the message that we've heard here today. So before we go into discussing, the advantages of a SPAC as what we're calling an alternative IPO, I would love if my panelists could also, my fellow panelists, could give a quick introduction about themselves. Maybe we start down here.
So Jay Heller, I'm with NASDAQ. I had capital markets. I've been there for 17 and a half years. I've overseen, including SPACs, 3,000 plus IPOs. I am a very firm believer in the SPAC structure. Looking forward to the conversation today, and I'm really looking forward to the panel and what's ahead.
My name's Asim Grabowski-Sheikh. I'm a partner at Baker Hostetler in their New York office. I've been involved with SPACs since about 2007, and looking forward to having a conversation today with everybody.
My name's Elliot Smith. I'm a partner in the capital markets practice at Perkins Coie in New York, and proud to be part of a firm that stands up to threats to the rule of law.
Excellent. Feel free to stand. Feel free to stand. Sorry.
It was all me.
And I'm Destiny Hance. I'm actually the Associate Director of Research now at Ladenburg Thalmann. We're a middle market investment bank with a passion for and commitment to connecting innovative companies with capital. And I have a different role than maybe, or perspective than you may have heard today. I know we heard from some bankers and some investors, but as an equity research analyst, I'm really curious, because I understand the importance of forecasting and modeling just in general as an analyst, right? But I'm curious how you all see modeling and forecasting and why that's super important when we're talking about SPACs as an alternative to an IPO. Like, really, what are the advantages there?
When I think about valuation, I think it's an extremely important topic. I think it's a topic that maybe sometimes people rush through, right? But the valuation is really important because it's really what's driving the transaction. The projections are nice and they give people a view as to what's going to happen with this entity once it goes public, what are the expectations, what's the path forward. But the valuation really kind of is the linchpin. And if you're over on the valuation, you open yourself up to litigation risk. You also open yourself up to poor performance afterwards, right? Because you're pegging the value to this $10 price, and then once you start to trade, if it's trading down, it likely means that the valuation was off in certain respects. So I think it's important to pay a lot of attention to it to make sure you get it right. I know that there's always a desire to move things along very quickly, especially in these types of transactions, but I can't underscore enough how important it is to have a really well thought through valuation.
Yeah, the one thing or a couple things I'd add to that is I think we've heard a lot at this conference about how maybe this time around it'll be different and we're going to be more disciplined and we're not going to rush into deals that really didn't make sense with companies that didn't deserve to be or weren't ready to be public. And valuation plays a big part of that. And there is a dynamic in SPAC world, particularly where you have many vehicles competing for the same targets, for SPACs to sort of tell targets whatever they want to hear, and it's a bit of a race to not the bottom, but the top of the valuation spectrum. And that can really set up, as we saw in years past, a very difficult dynamic for how the stock trades afterwards. So I have been in a number of processes over the last 6 months where sponsors are being a little bit more cautious around that and marketing their operational expertise and network to the target as opposed to simply blowing smoke at them with crazy valuations that have no bearing or aren't tied back to the fundamentals of the business. So it's a very important aspect, but it's one where it actually behooves the SPAC sponsors to be disciplined and to not get caught up in that sort of perverse incentive to simply give a target an insane valuation just to try to secure the deal.
Yeah.
Yeah, the only thing I would add is if you take just the SPAC out of it and you look at the capital markets as a whole, the bottom line is an investor, whether it's in the SPAC or in the D-SPAC, the M&A transaction, is no one in this room is in the business of losing money. Let's be frank. And in 2021 at NASDAQ, we were very fortunate. We had 752 IPOs. We had well over 400 SPACs. There was a lot of supply in the market. And valuations didn't matter, right? Everybody was happy and pretty much name your price, right? It was going on websites. And now I think the discipline has come back. The supply has tapered down. The deals that are still continuing to look for a target are getting there, but you're seeing this new iteration. Look, this year at NASDAQ, very fortunate, and we thank everybody in the room, we've had 54 SPAC IPOs. These are seasoned people that know what they're doing, that know how to find targets, and I'm really excited about the rest of this year leading into next year because the quality targets that are going to be presented with a potential SPAC, I think are going to be fantastic.
Yeah, and I think just building off the point that you're making here, Jay, is that there's maybe a greater level of maturity now to a lot of these targets. So you are having a more, maybe a more honest conversation or a more thought-through conversation about valuation. And what I like to say is that when you're a private company, when you're a target, it's easy for you to tell people what the value is of the company. Once you're a public entity, the market's going to tell you what the value is. So if you're really off in the beginning and it makes you feel good, you're not going to feel so good later on if you're trading down because there's an overvaluation issue.
Got it. And then, Jay, continuing with your point, we're seeing that, and I believe you just mentioned this, that a lot of the SPACs that have IPO'd are what I call repeat offenders, if you will. And
Seasoned.
Seasoned, sure.
Seasoned.
Okay.
Serial season.
Whatever you want to call them. But can you talk a little bit more about the advantages of having a very experienced sponsor and how the dynamic of the management team could be different? I'm thinking, I spoke yesterday at a conference where there was a first-time CEO trying to figure out the next step, the exit. Do you feel like there's an advantage to doing a SPAC as opposed to an IPO?
No, I think a lot of it goes to the experience. But what I would say is that, again, 2021, 2020 were fantastic for this SPAC vehicle. And it'll continue to be fantastic in the future. But there were many first-time, sponsors that haven't been through really the process. And this is a process. When you think about doing an M&A transaction and allowing people the opportunity to potentially say, yeah, I don't really like it. Mm-hmm. So what's unique about now is 2022 and 2023 and even into 2024, there was some activity on the IPO and even on the SPAC process. But what you're seeing, which really gets me super excited, is when people ask me, why are SPACs back and what are you seeing and why now? It's because many of the sponsors have a Roman numeral after their name. These are people that have been through the war, right? These are sponsors that know how to really work within tough times and, of course, in good times, and understanding that there are going to be ups and downs, but that is not the end of the road. And in many cases, the down times create opportunities. So as much as we welcome new sponsors, I think it's everybody's responsibility in this room, and we're all here today, from an education standpoint, from a partnership standpoint, but in order for this vehicle to continue in the future, you need that experience. And many of the sponsors that have been very successful in the past, if they haven't, their toes are being dipped back in the water. And I think that's really exciting because their experience is going to create great companies with great foundations that just need that help to kind of break out of that ceiling in the future.
Yeah, I also think, just kind of adding on to that point, is that if you do have kind of a serial SPAC sponsor, when you're approaching the target may have a higher level of confidence. Well, okay, these guys are battle tested, they've done this before. So that's great. It kind of adds to, maybe de-risking the transaction a little bit. But, at the same time, to your point, as long as people are educated and they understand what the process is, I think there's always room for new sponsors, and every serial sponsor was a new sponsor at some point in time. So the cycle will continue.
Agreed with all that. I think the sponsor quality is higher than it has been historically. The other piece, and I can say this because I don't work at NASDAQ, is that the IPO product is limited, and it only works for a few. And SPACs, the whole reason that SPACs exist is because there needed to be a democratization of access to public markets. And so that's why we're here, that's why SPACs exist, and I think that as long as there are these sort of structural flaws and a limited funnel, very narrow funnel through which companies can IPO, SPACs are going to thrive. And they're flexible, they're quick, they can be cheap, it can be expensive, but they're there for companies who can't otherwise access the markets. And I'm particularly thinking of a couple of clients that we have who have been told by bulge bracket banks that they are IPO ready, but the queue is probably 18 to 24 months long, and so it'll be the end of 26 before they can get out. And those guys are like, well, we need to eliminate the existential threat of our capital requirements now. How are we going to do that? And that's where SPACs come in, and I think that's going to create a positive dynamic. I mean, I do think the product thrives in a bull market, and I think we are starting to see that.
What you just said is something that really has resonated. The pathway to do the traditional IPO, and for me, it doesn't matter if it's an IPO, a direct listing, or a SPAC, we're going to support them along the way. But today it takes a lot longer to do the traditional IPO. It's no longer org up 6 months, let's go, registration statement, bring in the bankers, bring in the auditors, we're ready. As an operating company, I think a lot of it is we have to tell our story multiple times. We got to garner the feedback. We have to get it right. And so that 6-month window can become 12 to 18 months.
Yeah.
So if you're thinking about a shorter timeline, and if you believe, which I do, that the later end of this year, and you're seeing it now, but the pipeline is going to continue to build, and you're going to see more capital formation on the public side, and you're thinking about going public, but you're maybe 10th in the queue, and you're 12 months out, potentially you find a great sponsor that makes a nice marriage, and your window can be that 6 months. And so it all depends on really from what you, as a corporate, matching up with the right sponsor is what you're looking for. I think it's what it's all about.
Thank you. And I guess maybe we could move on to your thoughts and comments around pipe market, transactions, et cetera, and how you see the flexibility and stability of these financings.
I think that, look, it's no secret for the last few years it's been a pretty tough market on these pipe transactions. I do see kind of windows of opportunities, or at least things that are coming across my desk. I would say that there's a pretty significant focus on crypto, right? And if you have an opportunity and you have an entity that's involved in that space, you're going to have more traction. And if you look at kind of the companies that are operating in hot industries, if it's kind of high tech, AI, energy, you may have more stickiness, but it's really kind of about remarketing the transaction once you've signed up the deal, doing the roadshow, getting people's attention. Because if you're not doing any of that, no one's going to hear your story.
Sure.
I don't know. I think from the financing part, I'm a very big believer from a corporate side, take the money when you can, not when you have to. Because ultimately, if you wait until you have to, the financing rate, the financing terms may differ, really not in your favor. And so albeit, the pipe market has been slow to really come back, we're hearing a lot of great stories and a lot of capital being raised. And I think that's what's really exciting from a standpoint. There's convertible notes, right? There are preferred offerings. There's a lot of different forms of capital. But from the corporate side, you got to figure out what works best for you. And maybe if it's 2023, maybe the best I could do at that point was a forward purchasing agreement. And there's nothing wrong with it. I think it's understanding what you have engaged with, but taking the capital when you can is totally different from 24 into 25, and then ultimately it's going to change again in 26. It's not a bad thing.
Right.
One of the things that I'm excited about is that I think we do have an SEC that is more focused on capital formation
Great point.
than being a police officer and a gatekeeper. And I think that's evidenced by a recent no action letter and a set of CNDIs that came out in March relating to Rule 506C. And for those who don't know, 506C is a private placement exemption that allows for general solicitation. And historically, the issue with pipes and private placements in general is that you are not allowed to generally solicit the public to participate. That will bust your private placement exemption. 506C came out several years ago, and the rule required that issuers take reasonable steps to verify that the investors are accredited. And nobody really knew what that meant. And so everybody sort of stayed away, banks stayed away from that exemption, and they continued to limit the universe of investors that they could bring into a PIPE process. And essentially interpreting the verification requirement to require tax returns and other invasive information that investors simply wouldn't want to give up. And so in the earlier part of this year, Latham & Watkins put in a no-action request to say, if you have a minimum amount of required investment into a private placement, could that be indicia of being an accredited investor? And the SEC came back and said, yes, if you have a minimum amount and you have representations that the investor is accredited and that they're not getting financing for that particular investment from a third party, then that could satisfy the verification requirement. And so now you have Rule 506C being available to almost an unlimited universe so long as you meet that criteria. And I'm hopeful that that will be adopted more widely in the market and could potentially propel more PIPE participation from investors.
And I think if you're thinking about kind of traditional PIPE financings in connection with a de-SPAC transaction, if you can find those opportunities and you can secure that PIPE financing at the time you're announcing the business combination, I think that's a great thing. And it's only going to help the transaction because you really have an independent, institutional, often third party coming in. They're validating the valuation, to tie it back to our earlier point about valuation, which is, valuation is privately negotiated in a SPAC. You don't have an underwriter coming in and kicking the tires. So you have two private parties agreeing on the valuation, and now you have a PIPE investor kind of blessing it. They're also blessing the management team, right? It's a stamp of approval if they're investing in this transaction. So you have a lot of good things, a lot of market validating things that come out from a traditional PIPE investment.
I think it helps your balance sheet, or excuse me, your cap table as well, right? People always want to know when you're raising capital, whether it's an IPO or a SPAC doing a PIPE, well, let me see who actually has invested into this company. A lot of times, if it's just friends and family, it's nice, but when you can see some of these stalwart type of names that have taken the ride with you for not only the short term, but they're with you for the long term because they believe in who you are and what you can be, it really helps to really exemplify who you are and what you can be to really bring your brand forward.
Absolutely.
Well, I'm going to somewhat ask you to pull out your crystal ball here for a second, but I've heard and seen that the holding times of private companies has gotten a bit longer, just based on the nature of the IPO market and the markets in general. I'm wondering your comment about take the money when you can get it, as opposed to take it when you need it. How should a company and a SPAC balance those two things? Because the window is not open, and how are they going to? How would you suggest they manage that?
Look, I think for any company, you have to look at your horizon, right? What's my timeline? What are my short-term and what are my long-term goals? And in order for me to essentially meet my long-term, objectives, I may have to take some financing in the short term, even though I'm just padding my balance sheet today. Because essentially, your long-term becomes your short-term, and your short-term you need to execute on. And as soon as you execute on your long-term, you better make sure that you have something else for the future. So you just have to think about not so much in the short term. I always look at everything 6 months, 12 months, 18 months, 24 months out. Because at some point in time, look, we're halfway through 2025, right? The time has gone by very, very quick. And so ultimately, taking it when you can, if you can need it, that's going to put you in a better position. If your burn ratio is robust, maybe I need some more cash now. Maybe I'm not going to, if I'm a biotech, maybe I'm not going to commercialize for 2, 3, 4 years. Maybe taking it today, which is going to help me through my trials, is going to be more beneficial. If I'm technology and it's AI, it doesn't matter who you are or what you do. If the money is there and it's really at the, at a discount that's not as, it's not going to detriment you and it's at a fair value, I'm a big believer, take the money when you can. And so again, hit the horizon, look short and long term, because ultimately that long term will be here before you know it.
Right.
Yeah, I mean, and companies stay private for longer, right? So, and then they have kind of PE backing, they have venture backing. And if you're looking to have a really successful de-SPAC combination, then that may be the right move. Maybe you're doing an E round, an F round, a G round. You're getting the cash on the books, and that way, when you do go and you de-SPAC, you're less concerned about liquidity. You're less concerned about what does my 12 to 18 month runway look like? What are my liquidity and capital resources disclosures going to look like? Am I going to have a going concern out of the box? So you can solve for a lot of those issues.
Yeah, I think from my perspective, the market really dictates who's going to be able to come out, and that can be, related to sort of trends. We're seeing a lot of clients in the crypto space get investment from the Krakens of the world to actually go public at elevated valuations because they want to hit the market when it's hot. I think there's less of an appetite for companies that are obviously pre-revenue, particularly in the tech space. And so it really depends on kind of the landscape, both regulatory but market-wise, as to how early you're going to be able to get out and be public.
Got it. Okay, so how do you think when you're approaching a target, you should position yourself as a SPAC? Like, what are some of the key things that a target needs to know?
Well, I think for me, if I was an operating company, the first thing that I would really look at is history. Right? Who are the sponsors of the SPAC, and how can they help me? Right? This is a give and take. This is a partnership that's built for the long term. So I may be a tech company, I may be a consumer company, a biotech, sector agnostic, doesn't matter. But if I've executed to the best of my ability, and now I'm running into a ceiling, how am I going to break out? However, if I put this team together that has expertise and experience and can really help drive business and growth, and we're always thinking about what else we can do, there is without question a core benefit of engaging with a sponsor of a SPAC and doing a deal. You're giving away a little equity, but you're getting grandiose experience that can really help extend your business to potentially new verticals that you never thought about before. So for me, it's a little bit of speed dating. I think you got to find the right partner. And if you can, then you go to the dance with those partners. And again, it's all going to be on the company. So once you complete it, there is no free look, there is no free ride. I can guarantee you one thing, regardless of your structure, once you are a listed company, you better beat your metrics, you better beat your earnings, and you better have robust guidance, because if not, regardless of how you went public, if you miss, you will be punished. This market is unforgiving right now. But if you tell a great story, and you're showing that there is a future, and there are results, and there's a good future ahead of you, that is going to reward an investor as well. So, I mean, that's just the way that I look at it.
Sure.
Yeah, I mean, if I'm talking to a target who's thinking about going through a de-SPAC process, I think we're having a crash course in public company readiness, and what that means. Are you looking at your cap table? What does that look like? Are your investors going to be supportive? What conversations are you having? What are your internal controls and procedures, and how are you going to grow these things up so you can meet your public reporting and filing deadlines? Because if you miss those, you're going to lose market confidence in everything you're doing. You have to kind of go through soup to nuts, everything. You're looking at all your material agreements, you're looking at your balance sheet, you're thinking about your future, and how is the de-SPAC process going to be additive to what you're doing, because it is expensive to be a public company, and the disclosure requirements are are, you know, sometimes very, very detailed. And when you're a private company, you kind of do what you need to do, and you don't have to worry about that. No one has to know about executive compensation necessarily, or all these other things. So you have to spend a lot of time just doing corporate cleanup. You have to spend a lot of time doing education. And it's really the kind of that crash course, getting people ready for what life is as a public company in a very short period of time, because these deals are often very, very fast-paced.
Understood.
Yeah, I mean, I think in addition to that, sponsors who are approaching target companies, the value add that they can bring can be public company experience, a Rolodex of investors, but also access or assistance or facilitation to research, which is a key piece for a newly public company. And if you don't have research either out of the gate or soon after, that can really harm the trading of the stock. And so, to turn the spotlight on you, Destiny, I know you can't talk about how you get engaged, but would love to hear sort of the generalities around what you do, how you partner with, or how you know, what the process is for getting research, for working with companies that you cover, and just sort of an overview of Ladenburg's capacity in that space.
Sure, absolutely. So one of the advantages of a SPAC is that I could theoretically pick up research coverage of the SPAC tomorrow. And once you identify a target and you determine, you know, there's a firm agreement, I can begin writing research on that company. I can begin creating financial models. And we did 4 of these back in 2021, and we found that there was a lot more investor interest when they were able to come to us for a third-party, non-biased opinion. And we were not engaged in any of those deals. We were strictly a third party writing this research, engaging investors. I would say that that's something that people don't talk about enough. We heard a lot about being transparent with your shareholders, explaining the story, and having the opportunity sometimes for telling your more complex story over a longer period of time. But if you can have another person, another set of eyes, right, looking at your story and vetting it and saying, yeah, this is actually a good investment opportunity, and this is why, it's value add, and it goes really, really unrecognized. I would say that's got to be one of the largest advantages when you're looking at a SPAC versus an IPO. With an IPO, I can't write research within a certain window of time, and you have to be public. So even if I pick up coverage, it's not until that closes. But I see we're, you know, coming up on time a little bit. I'm wondering, would you guys like to take questions? Anything you want to add?
We thank you for sitting with us.
Yeah,
The music's in the background.
we got some very nice music going on.
Thanks very much for the deal flow for the conference.
Yeah.
This has been great. Appreciate everybody's attention. How about a round of applause for staff?
For real.